Time for the word on Wall Street. Top investors watching your money this morning, every morning. Joining me now, Mahoney Asset Management CEO Ken Mahoney, Amerivet Securities head of U.S. rates Greg Farinello, and Michael Lee, strategy founder Michael Lee. Ken, let me kick it off with you. U.S. markets are closed for President's Day, but futures are trading till 1 p.m. this afternoon. They're down across the board following another volatile week for markets. The Dow dropping more than 200 points Friday, after its worst day of the year so far on Thursday. This as tensions between Russia and Ukraine weigh heavily on investors. Your take on the geopolitical tensions and how that's impacting markets. Is it short-lived?
Well, this has been telegraphed for some time. I think some investors, institutions or otherwise, are going to get off sides here a little bit, buying puts, shorting stock. The sentiment is as ugly as you can get, Dagan. You got new lows in the NASDAQ. Looks like some type of chart you see Elon Musk, blasting off. New lows, new lows. And I do think if there's some type of deal, any type of olive branch that could work here, like the pressure you put on a beach ball, you push down and let it go and explode. I think we may be surprised from investors because of negativity and those shorts have the covers. I think short term, we can get some fuel going here and get the market going. After that, we have to deal with the Fed and inflation and so forth. But this could surprise investors. Like I said, I think most investors are off sides here. Too pessimism, oversold readings like you haven't seen. If we could just get something out of here short of invasion, I think the market could have a really huge rally.
Michael, let's talk oil. Oil prices up slightly this morning, about $0.50 a barrel, amid hopes of diplomacy efforts that could cool tensions between Russia and Ukraine. This as the growing tensions push gold to an 8-month high. Michael, your reaction to this, would you buy, say, energy stocks at this point with oil at higher than $91 a barrel?
Yeah, absolutely, Dagan. And let me tell you why. The oil market is in something that's called backwardation, which means the spot price or the price you would buy today is higher than the future price. And why is that? That typically happens when demand is higher than the supply, or there's a huge supply-demand imbalance. So the bull case for oil over the last several months has been that demand is going to continue to outstrip supply, and whether there's tensions in Ukraine or not, so not a lot of supply, it's not going to really affect the supply. So any sort of weakness from that, I would be a buyer. The only thing to be looking out for additional supply to come on the market is sanctions against Iran. And not only are we in a state of backwardation, it's one of the most extreme states of backwardation we've ever been in. And in Cushing, Oklahoma, where the physical WTI contracts are delivered, their stocks are at multi-year lows. I don't see this changing anytime soon. This is a combination of the hostility of the Biden administration towards fossil fuels, particularly oil, in addition to the economy coming back much quicker than anyone thought out of the COVID lows, and the supply chain woes that we continue to see around the world. So I don't see this changing, this supply-demand fundamental imbalance anytime soon. So yes, energy is the top holding in my portfolio, and I would be buyers of either the XLE or Chevron or ExxonMobil on any weakness.
I'll talk about this as the morning moves on. I just wanted to mention it, though, in terms of Biden and company's destruction of our energy economy, intentional weakening of the United States, both economically but on the world stage. We were the swing producer. We essentially controlled global prices of oil. Last Thursday, the Federal Energy Regulatory Commission, as the Wall Street Journal editorial calls it, bizarre timing, set rules that will block new U.S. natural gas pipelines. The rules are insane. The timing is even crazier. But again, they are still trying to destroy our consumption of fossil fuels to our financial detriment and to our detriment in terms of geopolitical power. Greg, let me talk inflation. Interest rates, Federal Reserve. Investors will be waiting on that key inflation data out on Friday. It's the Personal Consumption Expenditures Index. This, as J.P. Morgan economists are updating their rate hike expectations, saying the central bank will likely raise interest rates by 1/4 of 1 percentage point, 9 straight hikes. votes that would take the Fed funds rate to 2.25 by March of next year, 2023. Your reaction to that? What are you seeing?
Sure. Good morning, Dagan. Look, I mean, what I'm seeing, I think, is what everyone else is seeing, right? Inflation it's running rampant really around the globe. It's not just a U.S. phenomenon. And if you look at the rate structure, if you look at interest rates in general globally, even the ECB, the only central bank that's holding on here is the Bank of Japan. So, we wrote to clients last week, steady doses of 25. I am very sympathetic toward the JP Morgan outlook in terms of rate increases. I think the Fed needs to be careful. In general, I would say we've had very poor policies in 2021 on both the fiscal and the monetary side. But in the end, the Fed is the gatekeeper of inflation. So they're going to start going here. I think if you listen to some of the Fed speak from Friday, you listen to New York Fed President Williams, and we've been bouncing around on the probabilities, 25 versus 50. We spoke to Maria last month about this. We favor 25 to start, and we favor the Fed going in steady doses from there until we really get a clearer path in terms of where inflation is at. And when you look at risk assets, this is the challenge right here. Whether you look at equities or whether you look at credit, you look at risk assets across the board, until we get a clearer sense of where inflation, where that trajectory is actually going to head, I think markets are going to have a tough time here. Short term, for this number this week, we don't see the Fed getting any alleviation short term in terms of the inflationary dynamics, but I think they know that. And I'll sort of end on this. If you look at financial conditions, though, the Fed transmits policy through expectations. And if you look at where the markets are priced, you look at the repricing in general around risk assets, not really around fundamentals, but around volatility, they've already transmitted, I think, a fair amount through. So the markets are, I think, taking a pause here short term, but we need to get past this March meeting.
I said that I thought that the Fed for several months was just trying to jawbone asset prices lower to bring them more back into reality, if you will. So you're saying it worked a little bit. We'll see how much more it works before they actually must take action. Thank you so much, Gregory Farinello, Michael Lee, both of you gentlemen. Ken Mahoney, you don't move. You stay right there. You're with us the rest of the morning. And much more.